By the year 2026, the most dangerous place to store your life's work is in a safe investment. We have been conditioned to believe that preservation is the same thing as security. Your bank manager, your risk-averse parents, and every mainstream financial advisor tell you the same thing. Once you have some savings, move them into bonds, certificates of deposit, or Treasury bills to protect your principal. They are lying to you. In fact, if you follow this standard advice, you are participating in a slow-motion wealth confiscation program. In the current economic climate, a 5% CD isn't a profit center. It is a guaranteed way to lose 3% of your purchasing power every single year. Today, I am going to prove to you with brutal, cold-blooded arithmetic that safe investments are a structural trap designed to harvest the middle class. I am going to show you why the very tools meant to protect you are actually the primary weapons the system uses to liquidate your future. You aren't being cautious, you are being fleeced by a system that needs your safe capital to fund its own survival. The reason you fell for this is rooted in a psychological phenomenon known as nominal loss aversion. Humans are biologically wired to fear seeing a number go down on a screen. If you invest in the market and your balance drops from 10,000 to 9,000, you feel a physical sting of pain. But if you keep 10,000 in a safe CD and the price of rent, energy, and healthcare doubles, the number on your screen stays at 10,000. Your brain tells you that you are safe even though you are now 50% poorer. The system exploits this evolutionary glitch. It markets guaranteed returns as a sanctuary, but it never mentions that while your principal is protected, your purchasing power is being incinerated. This is the money illusion. You have been validated by a society that prizes the appearance of stability over the reality of growth. The system was designed to keep you in fixed income products because a population that buys government debt is a population that funds its own devaluation. When you buy a bond, you are lending money to the very entity that is printing more money to ensure your loan is paid back in cheaper dollars. It is not your fault you feel the urge to be safe. You are fighting a multi-generational conditioning campaign designed to make you a voluntary creditor to a bankrupt system. Let's look at the hidden math that the low-risk brochures conveniently leave out. We're going to look at scenario A, the cautious conservative. We'll call him Safety Tobi. Tobi has $100,000. He's terrified of a market crash, so he puts his money into a high-yield certificate of deposit earning 5% annually. Tobi looks at his statement at the end of the year and sees $5,000 in interest. He thinks he's making progress, but here's the stealth tax math. First, the IRS takes its cut. Interest on CDs is taxed as ordinary income. If Tobi is in a 24% bracket, his $5,000 instantly becomes $3,800. Now we factor in the real inflation rate. In 2026, while the government claims inflation is 3%, the actual cost of living, the things Tobi actually needs, like insurance, quality food, and housing, is rising at 7%. Tobi's $100,000 lost $7,000 in value this year. He gained $3,800 in interest, but lost $7,000 in power. Tobi's safe investment actually yielded a net loss of $3,200. After 10 years of being safe, Tobi's $100,000 will buy what $68,000 buys today. Tobi didn't protect his money. He handed the bank 32% of his life's labor as a donation. Now, let's look at scenario B, the reality. This is Larry. Larry knows that in a world of infinite printing, only finite assets matter. Larry takes his $100,000 and avoids the debt-based safety trap. He understands that a bond is just a promise to pay back paper that is becoming less valuable by the hour. Larry puts his money into productive assets, index funds that own companies with pricing power, or scarce physical assets. Even if Larry's volatile portfolio only grows at the same 5% as Tobi's CD, Larry wins. Why? Because Larry's gains are taxed at the long-term capital gains rate, which is significantly lower than Tobi's ordinary income rate. More importantly, Larry's assets have inflation linkage. When the price of goods goes up, the revenue of the companies Larry owns goes up. Tobi is holding a fixed contract for a fixed amount of paper. Larry is holding a percentage of the global economy. Over 10 years, Larry has preserved his purchasing power, while Tobi has been liquidated. Consider the real-life case of Tobi. Tobi is 55 years old. He worked 30 years to save $500,000. He was told to move 60% of that into bonds to de-risk as he approaches retirement. In 2026, a sudden spike in energy prices sends the real cost of living soaring. Tobi's bond portfolio pays him a fixed $25,000 a year. 3 years ago, that $25,000 covered his basic expenses. Today, due to the cumulative effect of stealth inflation, those same expenses cost $38,000. Tobi is now forced to sell his bonds at a loss to cover the gap. Because interest rates rose to fight the inflation, Tobi's bond principal has actually dropped in value. Tobi is trapped in a death spiral. He's losing money on the principal and losing money on the purchasing power. Tobi realized too late that safe investments are only safe for the person borrowing the money, the bank or the government, not the person lending it. This is the reality check. In a debt-based monetary system, the saver is the victim and the borrower is the winner. If you own a safe fixed income asset, you are a creditor to a system that is actively trying to devalue its debts. To survive 2026, you must stop being a lender and start being an owner. The solution is a cynical but necessary shift in strategy. First, you must redefine your emergency fund. Keep only what you absolutely need for 90 days of survival in cash. Treat this cash as an insurance policy that has a premium. The premium is the 7% you lose to inflation. Beyond that, every dollar sitting in a CD or a bond is a dollar that is being stolen from your future. Second, you must embrace volatility as the price of safety. A stock market dip is temporary. The devaluation of the dollar is permanent. You have to be willing to see your balance fluctuate by 10% to ensure your purchasing power doesn't vanish by 50%. Third, ignore the age-based asset allocation rules. The old rule of your age and bonds was written for an era when the dollar was backed by something and the national debt wasn't $40 trillion. In 2026, that rule is a suicide pact. If you are 60 years old, you need inflation protection even more than a 20-year-old does because you have less time to earn back what the system steals from you. Fourth, look for hard yield. If you want income, look for dividends from companies that can raise prices or rental income from real estate. These are safe because they are tied to human needs, not government promises. Safe investments are a scam because they exploit your fear of the future to ensure you have no future. They turn your most valuable asset, your stored labor, into a fuel source for a bankrupt financial engine. You are being sold the peace of mind of a guaranteed return, so you don't notice the guaranteed loss of your freedom. Your bank account is not a vault, it is a sieve. If you want to be truly free, you have to be willing to look risky to people who are broke. Real security is the ownership of things that cannot be printed, taxed into oblivion, or liquidated by a central bank. The path to real wealth isn't paved with certificates of deposit. It's paved with the courage to own the machine instead of lending to it. But the safe investment trap is just the first layer of the control mechanism. The same institutions that want you to hold their devaluing bonds are the ones telling you that renting is throwing money away, while they trap you in a 30-year mortgage that ensures they own your labor for the next 30 decades. If you think the bond scam is bad, wait until you see the math on the starter home trap that is currently destroying the wealth-building potential of the next generation. Stop being a safe loser. Start being a volatile winner. Because in a world of infinite printing, the only way to lose is to play by the rules of the printers.